Attention, Cleveland home buyers. Is April a good month to buy a house? Get an update on what's happening in the real estate market by listening to Mike Reilly and Mike Ferrante. Are we seeing an inventory shortage? Could Cleveland real estate be experiencing a bubble? This and much more on the Cleveland Real Estate Investor Podcast.
Hi, everybody. This is Mike Reilly with Cleveland Real Estate Investor. And with me is my caffeinated sidekick, Mike Ferrante. Good morning, Mike.
Good morning, Mr. Reilly. One cappuccino down and I'm ready to go.
Well, as I was saying earlier, I'm looking at your new Zoom picture, and it's a C21. It's not that Mike Ferrante leaning against a barn door with his cappuccino. So not the same vibe here. So anyways.
We'll make up for it with energy.
I know. Well, we got a gray day in Cleveland. It's going to be struggling to even hit 40 today. But next week, Easter week, it's going to be 70s and 60s. So we're almost out of the woods. All right, Mike. Well, speaking of weather, let's talk about April heat check. So,
yeah, sounds good. Mike, I've gone to tracking the numbers weekly because I want to see what's going on. You know, it's really interesting to see what's happening with the inventory shortage. Here's what we're seeing. New listings are I want to say pouring in, but it's more of a steady stream. Like last week, for example, in our market, the Cuyahoga County market, 248 new listings, which is up from, low 200s, even in the 100s beginning of the year. So we're seeing that usual trend where more and more homes hit the market in the spring and summer. So that's a positive. However, the total inventory level is still pretty low by comparison. I would say it is trending downward still, but it's kind of flattening out. 1,106 total active listings, and that's not what we're used to. We're used to somewhere between 4,000 and 6,000 listings in our market. So what I'm seeing is the number of homes that are going under contract. And by the way, I'm looking at singles, condos, and multifamily, like duplexes, threeplexes, that kind of thing. Across the board, the inventory is just getting bought up as fast as it's hitting the market. And that's why we don't have that rise in overall inventory level.
okay, so it's there's a kind of mentality out there, I would think, that people are saying, I better buy this now because this could be my only chance, right?
That's right. So something new hits the market. They know there's going to be competition, and I'm sure we're going to get to this, but with the rise in interest rates, I think that in the long run, the rise in interest rates is going to slow down demand. In the short term, what's happening is buyers are panicking. They're saying, oh crap, if I don't buy soon, my rate's going to be 5, 6, or who knows what.
Yeah, but the interesting thing about the interest rates, which I've been following, because our portfolio is in real estate, but it's also in we got a lot of stocks. Is interest rates are returning to what they normally were.
That's right. Yeah, that's exactly right.
So people are getting freaked out. Interest rates are rising. Hey, trust me. My wife and I, we bought our first house, which we are still living in 39 years ago. Interest rates were 16%, 15%.
Yeah, you'd have killed for an 8% rate, right?
Well, I don't think it's going to get to 8%. What do you think the max is going to be this year?
Oh, this year, yeah, I don't think the Fed is going to react to the point where they're going to make interest rates hit 8% by any stretch. But I've seen some forecasts that say that 8% could be a reality by the end of next year.
Oh, well, that's next year. Yeah, I get it. But that's still, historically, what has been interest rates, 5 or 6%?
Yeah, that 5 to 6% has been, quote, the norm. And if you look at it decade by decade, even up to 6% is still an amazing mortgage rate compared to what it's been over the decades.
Right. And what is it now?
We're still seeing rates in the 4s. Of course,
Okay.
it depends on down payment, type of loan, your
Credit
credit score. Yeah,
Right.
exactly. But we're there. You can still get rates in the fours. Threes are really tough to find these days. I think it's pretty much in the fours right now.
And most of these buyers coming in there, it's a cash deal, right?
Well, many. And of course, to compete in these multiple offers, which, as part of the heat check, I wanted to share a quick story with you. But yeah, to compete against all the multiple offers, many people have resorted to using cash, even though they want to use the leverage of these still relatively low mortgage rates. Just so to the story, as part of the heat check, people are probably thinking, oh, well, maybe things are cooling off a little bit. No, we put a new listing in last week, and over the weekend, 46 offers on a single family home in Berea. And it wasn't anything special. It was nice, but 46
Wow.
offers, Mike. It was absolutely insane. And that's becoming the norm.
Right. Right. Wow. That's okay. Okay. So keep going on heat check. Let's kind of do a little quick recap summary and add your
Uh,
story. 'Cause
yeah.
this is
So that, I mean, obviously that kind of is that exemplifies what's going on in the market. Now, not every listing is getting 46 offers. And I think, of course, sellers are still reacting and saying, well, the market's up. Let me test it and see how high I can price. So you still have the listings that come in and maybe sit for a week, 2 weeks, and with no offers. So there is a limit to how you can price. But because there's a shortage, the new listings, the incoming listings are rising, but the demand is still meeting that rising tide. So you've
okay.
got a break wall, envision a break wall. Even though the tide's crashing in, the break wall is still catching it. And the number of sales is still very, very consistent. But be prepared for competition if you're looking to buy. And if you're looking to sell, absolutely seller's market, but there is a limit. You
Right.
can put a listing on the market for a price that's too high. And for those sellers who are saying, yeah, but I'm going to list it real high, and if someone wants it, they'll make an offer. No, they don't, because buyers are now conditioned to expect multiple offers. And they say, if it's priced at that, there's no sense in me offering this.
Right. Right. Okay. Now, who are the people buying? I mean, I've been following the Cleveland Heights City Council Housing Committee with rapt interest, and we're going to do a podcast on that down the road. Some of you heard Tony Kuda, the new councilman who chairs the housing committee. He was on one of our podcasts I think it was about 2 months ago. But I've been watching their weekly housing committee on Zoom, and the big bugaboo with some council people on there is investors buying. These big bad investors coming in. Who are buying these houses? Can you tell on your analytics?
From what I have pulled up right this second, no. But what I can tell you is that nothing has changed, that there's still a good mix of owner occupant buyers and investor buyers. And when I say good mix, it also depends on the location. So as we've talked about previously, because of the way Cleveland proper is priced, the way the values are, the way the housing stock is, a big percentage of buyers in Cleveland proper are investors, unless we're talking about premium areas like Ohio City, Tremont, where the prices are not conducive to investor purchases, and especially multifamily homes. You're still seeing investors scooping up all the multifamily homes they can get their hands on, because even though our prices are rising comparatively to, say, markets like California, New York, Florida, scooping up a $200,000 duplex here where the rents are $2,000 a month or more is still a fantastic deal for cash flow compared to what they can get. Now, that said, in areas like Cleveland Heights, parts of Cleveland Heights, and the other suburbs around Cleveland, you have the majority are owner occupant buyers. So you have move up buyers, and it's particularly in the lower price ranges, say the 75 to 300 range. The competition there is especially fierce because there's so little inventory in that price range.
Okay, so give me that price range again, between 75,000 and 300,000.
75 to 300, I think, is where the competition is especially fierce.
Okay. And what are the returns that these investors are looking for? So you buy a house, let's just say you buy a house for 125,000. We have one of our our houses on our prospectus round 2 this year is 125,000. The rent is 1,000 a month. The tenant's in place, and the tenant is responsible for repairs, and he has done the repairs. He's been in that house for over 10 years. So he treats it like his own house. He just doesn't want to own a house. So we give him a discount. Normally that would be, say, $1,200 a month, but he's doing close to $2,500 in terms of repairs a year. You know, getting the house painted, keeping that, maintaining that, cleaning the gutters, cutting the grass, you know, the whole 9 yards.
Sure.
So let's just say, for discussion's sake, that, okay, here's a house for 125 and the rent's 1,200. Okay, now, how's that
That's
for a
spot
return?
on. Yeah, that's spot on for what investors are looking for. A quick and dirty way to figure out what the desirable return is and what a typical return is here in Northeast Ohio is the 1% rule. So if it's a $125,000 house, 1% of that is $1,250. So
Okay,
with all the variables you talked about, who's paying the water and sewer, who's cutting the grass, shoveling the snow, doing the maintenance, you know, the taxes, how much are the taxes on that house? With those variables can skew things one way or the other. But if you're over 1% in general, that's a really good return. And if you're under that, depending how much under, it might start to be a little out of the range of what investors are looking for. But compared to markets like I mentioned, that's still an incredible return. You know, when you calculate it out as an ROI, you're still making 8, 9, 10% ROI, which in markets where the prices are considerably higher compared to the rents, you're lucky if you're making 2 to 4% ROI.
wow. Let's take our mythical LA investor who's spending, just walk me through with the LA investor who owns property in California is facing.
Yeah, my buddy Kareem, I introduced you to Kareem. He's out there in the Orange County market, and he was telling me exactly that. He's like, look, if I want to buy investment property out here, I'm buying for appreciation. Cash flow, I'm lucky if I'm getting cash flow. So 2, 3, maybe 4% is what he's expecting to make on his investment, but he's hoping that the appreciation keeps happening like it is now.
Right.
By comparison, out here, what we've experienced in Northeast Ohio is a really nice cash flow, and the appreciation is the gravy. You know, we typically have 2 to 3% appreciation, but we've been more like 7% the last 3 years on average.
Right. Now, how do people make money in Cleveland? You know, you hear, we did these podcasts a year ago, and I want to revisit this, where, you know, somebody buys these houses for $50,000. Again, their rents, they're looking to get a rent for $500.
Well, if you're buying a $50,000 house, you're in a more risky area. So on paper, you're probably looking for more like $750 to $950 rent.
Okay.
But you know, you're not going to find a $50,000 house anymore, even in the inner ring suburbs. So when, you know, I'm talking about Euclid, Garfield, Bedford, yeah, you used to be able to find those deals, but not anymore. So the $50,000 house is more Cleveland proper, maybe some areas where there's higher risk levels, you know, and we know what we're talking about as far as risk. And the way you make money is having good management, first of all, because that is a more difficult form of management. And, you know, the saying that I always say is you make your money on the buy.
Right.
So, you know, these investors that we've talked about over the years, Mike, and I've worked with, they say, oh, I bought a $50,000 house and it's, you know, it rented for $850 a month. I'm making so much money. And then they come to find out, well, the tenant stopped paying rent. There's an eviction. The furnace just went because the $50,000 house was just kind of spit shined and nobody really went through it to make sure the mechanicals and the other systems, roof, windows, et cetera, were in good shape on the house. Or here's a good one for you, Mike. I just had this happen. Investor came to me and said, I haven't had my house rented in a year and a half because the city came in and hit me for a lead violation. And I'm not allowed to rent this house back out until I abate the lead. How's that for a good investment?
Right. And we got a new mayor too. And their new mayor means, you know, new energy. And they're certainly going to go after the whole lead thing. And then, of course, everybody should go scroll back, you know, a year ago for our famous landlord from Israel who got shot, right?
Oh yeah. Yeah, that made the news. He got shot in Mount Pleasant. So when you talk about risk, this guy literally was going
We're
to
not
his
talking about money risk. We're talking about getting shot risk, right?
yeah, all aspects of risk. I mean, when people ask me, Mike, what do you mean by risk? That's a terrible story. The guy
Yeah, it
literally
is.
got shot in the back of the head. Now he's end of the story here. Spoiler alert: he lived. He only was in the hospital for 2 weeks and only had a severed vocal cord and only can whisper right now. It never really got his voice back.
Yeah,
But hey, that was his risk.
yeah, exactly. So, okay, so now let's also talk about duplexes. Duplexes are the hot vehicle, right, Mike?
For sure. Yeah, you can't keep a good multifamily home on the market right now. I'd say just as hot or maybe hotter than single family.
Okay. So why would somebody, to me, it's like when you have duplex, you also have the potential of, tenants fighting amongst themselves. I
Mhm.
mean, you have to have quality tenants in there who are going to behave themselves, right?
Yeah, I mean that's the conversation that we have is people say, well, clearly the multifamily is the way to go because on paper the cash flow is higher. And I
Right.
can't I can't argue with that. On paper, absolutely. But there are some variables that people don't take into account. For example, what you said, the conflict between tenant, higher intensity management because you're having to resolve those conflicts. How about turnover? Your single family homes, I'm sure you can attest to this, Mike. Your single family homes, you tend to get people who treat it like their own, like your guy you're talking about. I think I know the house you're talking about. That guy's probably been there 10 years and going to be there another 10 years. How's that
Right.
for lack of turnover? Duplexes, threeplexes, you tend to get more of an apartment mentality dweller. And there's nothing wrong with that. But what do apartment people do? They move periodically, maybe looking to get their own space, their private space, their own backyard for their dog, not have to fight for the parking spot in the driveway. So, not that there's anything wrong with them, but it's just a different style of management.
Right. And you also have to make sure you have a good property management company. And those are, I mean, give me the heat check on property management companies. Are the good ones not closing their doors, not taking any more business? And what's left is a hodgepodge of amateurs doing this.
Yeah, I mean, I hate to say it, but you're 100% right, Mike. There's every Tom, Dick, and Harry thinks they're a property manager. You get the contractor who says, "Well, I rehabbed 3 properties for you. Sure, I can manage them." First of all, that's not technically 100% legal if they're doing full-fledged property management. There's technically to get a full-fledged property manager, you're looking at real estate brokers, and that complicates things too. Now, I
Yeah.
know, if you're doing things a certain way, you can get around that and not do full-fledged property management. But that's a concern as well. How reputable is the person that you're using? Is it a guy in a rusty pickup truck, or is it a company with insurance and
Yeah.
and experience?
Well, and
So
also being proactive. I mean, that's what I've noticed with property managers. They don't really check the house out. They're not making a tour of the house, let's say once every couple months, just to make sure the tenant is taking care of the house. I mean, we're not talking about going in there with a white glove inspection, but I'm
right.
talking about just literally driving past the house. Is there garbage strewn around? Is there tire tracks, in the front yard because they got 3 cars in a driveway, they can only fit 2. I mean, these are the little things that you look for. Is
Sure.
the person, I mean, just basic, you're expecting a tenant to do a modicum of maintenance to the house, like picking up the trash. And, a lot of times the best way of vetting a potential new tenant is literally drive over and see where they're living now and see how they're taking care of it.
I've done it
And
myself. Yeah.
yeah, exactly. So this ability to property manage is not just get the tenant, but keep your eyes on the property. And so, hey, everybody out there looking to buy in Cleveland, lining up the property management first is the most important thing. The most important thing. And then buy the house. That's called put the horse in front of the cart, not the other way around. And we've talked about that. This is kind of like a greatest hits podcast today, Mike.
Yeah, I just had a consultation with an investor who came through some online source, saw us on Zillow or something. And she was a sharp gal, first time investor. And she kind of understood the concept of assemble your team first. And
Right.
it was refreshing to hear that, because so many times, Mike, you and I both get the people who said, "Hey, I bought 3 houses and I'm having problems. Can you help me fix it?" Well,
Right.
it's kind of like checking your oil before you drive your car. Don't go driving your car around if you've not got any oil in it, because now we're putting in a new engine.
Right. Right. And I think for some people, a person I talked to a week ago, called in, was looking to invest in Cleveland real estate, and she had lived in Cleveland, 30 years ago. Went to Cleveland Institute of Music, was a musician in the Oregon Symphony, and so she called me about wanted to talk to me about investing in Cleveland. She wanted stable cash return, and of course it's like me saying, well, you know what, I want to get a 10% return on my portfolio. Yeah, okay, well, good luck with that. It's dicey. Well, I ended up just listening to her, and she was going to have to take out a loan to buy a house, a rental property. And I told her, you know what, I want you to be the tortoise, not the hare. The tortoise is, don't buy real estate in Cleveland. It's too risky. Instead, just, you know what, just buy in the market. Just buy some stocks. You got your IRA, buy some stocks, do some research. And, if it's an IRA, if you're saving for the next 10 years, you got a long runway, and you're going to do a lot better than buying real estate in Cleveland, which to me is extremely risky if you're out of state and you're taking out a loan. Your thoughts?
I agree. I think that people who look at real estate purchases in the same way that they look at an investment tool don't understand the business. There's so many intangible risks that are really hard to quantify. And, I know from experience, hearing stories from people, well, I can't believe, my manager did a terrible job. I had to replace my roof and I made no money last year. Well, that's not your manager's fault. That's your fault, because you bought it and didn't budget for that. You didn't know that your roof only had 2 years of life left on it.
Right. Right.
Yeah,
and
completely
I think
different.
there's such an industry out there. We'll talk about this, in our Small Business Confidential, but it's almost like this self-perpetuating racket about real estate, buying books, webinars, seminars, how to invest in Cleveland, that gives people a false sense of security of investing in real estate, as opposed to something like being the hare. Listen, go in and buy 10 or 20 stocks, allocation, split up, buy biotech, transportation, energy, whatever. Look down the road in terms of future technologies, invest in that, like robotics or biotech, which I've invested in. Just something as simple as robotics, where in 5 years' time, Mike, given the housing, not the housing, but the staffing problems for retail stores, grocery stores, fast food, everything is going to be done robotically. You're going to have literally one person running the store. It's going to be drive-through, because it's just so hard to hire people and to keep people. So there is a huge need now for automated operations. We have 3 women who work for us in the Philippines, and they're scattered in different cities, and they do all our back office bookkeeping. Everything goes up in the cloud, and they do the invoices. Well, you could easily have somebody in the Philippines on a Zoom or on a Blink camera or something like that, literally working at a movie theater. I mean, we went to see a movie last week, and here's one person selling the tickets, and there's nobody there taking the ticket at the, at the entrance to the movie theater. And I thought to myself, I could have just walked in here. But the point is, down the road, you may have somebody in the Philippines with a camera. You're going to hold up a ticket, and that's it. They're going to let you in, and they're going to be doing this remotely. That's what the future is here. So, and that's what you should be investing in. So with real estate, you're investing in the future, right? You're looking for appreciation. That's what our LA realtor is doing.
Right.
He's assuming that he's going to get a 3 to 4% appreciation every year. And so he's investing in the appreciation, but he's got all these headaches he's got to deal with, right? The managing, the repairs,
right.
An earthquake hits, a fire,
Sure.
Who knows? Doesn't sound like a particularly great way to invest your money. So anyways, let's recap on heat check for April, Mike.
Yeah, so it's still, if anyone's thinking, oh, rates going up, or war in Ukraine, some outside factor is going to slow down the market. So far, that's not happening. I think at some point it will even out as markets tend to seek an equilibrium. But for now, more of the same.
Sellers market.
Sellers market, inventory still dwindling, although it seems to be flattening out. Activity, though, number of sales still up, right where it is typically for this time of year.
Right. Now, the $1 million question. When is the bubble coming in Cleveland real estate?
Well, an even better question is there a bubble coming? I would contend that because this looks a lot different than 2008 to 2012, that if anything, I think we're going to see a plateau. I don't think that we're going to see a drastic drop in values, which is what most people think of when they think of a bubble. I think that the change is going to be gradual. So in other words, what's going to happen is demand is going to gradually ease up. Supply will continue to gradually ease upward. And eventually you'll reach another sort of equilibrium where it's a balanced market.
Right. So interest rates are going to go up a little bit, not a lot,
sir.
but they're definitely going to go up to that 5-6%, which is going to wash out people who are suddenly not going to be able to buy a house, right?
That's right. Or they're going to qualify for less. They were set on Mayfield Village. Hey, I can afford Mayfield Heights, Mayfield Village. Now rates are going to go up, and that person who just barely qualified is going to say, well, no, I don't afford that area. I can't afford that area anymore. Now I can only afford over here, and they're going to be taken out of the market.
Right. So now you have less demand with the rise in interest rates. So folks, less demand, which means that you're going to start seeing that equilibrium. You're going to start seeing that plateau. So we're not forecasting suddenly a crash happen.
Yeah, unless something really unforeseen happens. We can't predict, another big war or another pandemic. Something like, I think it would take something like that to cause some kind of catastrophic drop in the market.
Right. Well, we saw what happened with the pandemic in the real estate.
Well, even the pandemic, so that's the thing. So look back 2 years, what we saw was a 2-month drop in the market. People panicked. It's kind of like the toilet paper. Everyone was making jokes about real estate and toilet paper
and flour.
Yeah,
flour.
yeah. But what happened after 2 months? People realized, okay, the world's not ending. And I'll tell you what, after March, April, May, things got back to normal. And in fact, it was like they got set on fire, because all that pent up demand from that 2 months while people were sorting out the pandemic, May, June, July, and the rest of the year more than made up for the sales that didn't happen in March and April.
Well, and I think the pandemic blew a hole into this communal living. People wanted their own space if they're going to be working from home. So there was suddenly a huge unexpected demand for single family houses.
No
you
doubt,
know?
no doubt. And of course, the opposite happened during the recession. People started living together. You had multi-generational families living together. Now, all of a sudden, people are trying to get out of that. Not suddenly, but over time, they decided, okay, it's time for us to get our own place again. Our foreclosure, our short sale is now 5 to 7 years in the rearview mirror. It's time for us to get our own place again. No
Right.
longer do we want to rent; we want to buy. And the type of property people are looking for has also changed. And Mike, you hit the nail on the head just recently. I was talking to a pair of buyers who said, guess what? We need a home that has these criteria: bedrooms, bathrooms, and oh, by the way, 2 separate work from home spaces. That's unprecedented. Prior to the pandemic, you never would have someone asking for that as a criteria.
Well, it's not just the pandemic, but it's the 5G. It's the cloud, like I was saying with the Philippines. Offices now are going through a major shift where you really don't need to go into the office, and you're a lot more actually productive
Yeah.
working from home. I know I am. I mean, I'm rehabbing from hip surgery, replacement hip surgery, and people say, "Well, how's it been? Working from home." Well, that's what I've been doing the last couple of years. So it's
Yeah.
not like things have changed. And
I'll
so,
tell
and
you,
my
Mike,
wife,
I got
go ahead.
a topic for future podcasts. We got to get a commercial real estate expert on because I don't have this answer. But what does that mean for office space, for
I
retail?
was just going to say that because what I'm thinking of is I'm looking at, my favorite building, the Medusa building.
Yep.
And I'm looking at these empty storefronts and I'm thinking, why can't those be converted to apartments? I mean, really?
No reason. Yeah,
I mean, so throw in a bathroom, why do I think that's where the demand is now,
that's right.
right? So not for these, retail space. And it's not just like working from home retail space. It's the rise of Amazon. It's the rise of buying online. I'm like, what is the point of going to Beechwood Place or some mall? Those days are over. I mean, I
That's right.
can't, I mean, to me, going to a mall to buy something is like going to get, root canal. I mean, it's, it's not what I'm looking forward to do.
Yeah, you
Uh,
mean I got to leave my house to get something?
well, I don't mind going to like On the Rise, the bread store. I don't
Yeah,
mind going to some place where, there's some people there and, get a coffee, Phoenix coffee, go out to eat, stuff like that. But the thought of going to a strip mall to buy something when you don't even know if they have it, when you can
yeah,
just sit at your laptop and just okay, yeah, I'm looking for XYZ, and it's right there. It's right there at your fingertips.
even
And
groceries, Mike. Even groceries. I'm saying, hey, send me a bunch of bananas and 3 green peppers and 5 tomatoes, and it ends up on my doorstep.
right, exactly. So okay, well, put that down on your things to do, Mike. Commercial real estate, and
You got it.
because that has got to be changing. And so, all right, so no bubble. We're looking at probably in about 6 months, things starting to plateau as interest rates go up. It's still a seller's market within reason, right? It's not an
Right.
LA, setup. And yeah, okay. So I think right now, I think you've answered my question about the April heat check. Our next podcast, we're going to do a little deep dive into nuisance abatement, which is now we're starting to see that happening down the road. Now, what does nuisance abatement does for you investors out there? What it does is it opens up a whole new vehicle for buying properties instead of going through the MLS or going through guys like you, Mike, the realtor.
That's right. Yeah. Hey, there's more than one way to buy a house, buy a property.
Exactly. All right, we're going to end it there. Mike, thanks a lot. And
My pleasure.
folks, we'll be back on in about a couple weeks. Okay. All right. See you, Mike.
See ya. Take care.
Thank you for listening to the Cleveland Real Estate Investor Podcast with Mike Reilly. Please add our show or follow us on Spotify, Overcast, Apple Podcast, or Spotify. Leave a like or comment on the video. All engagement is appreciated. Subscribe to us on YouTube as well for video content coming soon. For any Cleveland listeners or Cleveland Browns fans, you can check out our other podcast, Cleveland Browns Anonymous, for our weekly group therapy session. This is also on all the same platforms as the Cleveland Real Estate Investor.